Let's turn back to the major indexes now. Joining me is Keith Fitz-Gerald, principal at Fitz-Gerald Group. Keith, it's good to see you on this Friday afternoon. Kind of just a mad day, not a lot of movement, despite, I think, what was some big news this afternoon, that the White House is taking down its infrastructure spending plan to try to get to some middle ground with Senate Republicans to $1.7 trillion from $2.3 trillion. What is your reaction to kind of a lack of movement in the stock market based on that news?
Well, I tell you what, to me, this is kind of par for the course because the market is really far more focused on the Fed than they are on the politics of the stimulus bill. I mean, don't get me wrong, they're going to take it. It's good. We need to help millions of people. We need to move this country forward. There's no doubt about that. But the leverage that most of these big traders carry behind the scenes is really what's holding things back.
Interesting. So I want to talk more about that. In what ways is it holding back what we see happening in the market, and what does it portend as to what will happen as we head into these summer months?
You bet. So bear with me on this because it's a lot of behind the scenes. So big traders typically carry $3, $4, $5, even $10 borrowed for every $1 they've got in the portfolio. When interest rates rise, that means the cost of borrowing all that money has to go up. So what they do is they typically sell the big liquid names as fast as they can to avoid a margin call. It's called value at risk. They don't want to be exposed if the rates get higher. So this cycle with the Fed, here's how it works. If every time the Fed says we're going to raise rates, or they hint that they're going to raise rates, or the T-bill goes, the 10-year goes up, the potential cost to these big traders is huge. So they start selling. The computers jump in, you have a race to the bottom. When everybody deleverages, then it powers back up. And that's what we've seen over the last couple of days, is this constant battle. As investors, this sounds hopeless, but it's actually not, because as individual investors, we can take and pick our battles very carefully. We can look at a company like Apple and say, you know, 3, 4, 5 years from now, these daily squiggles are not going to be relevant. So it makes sense if a company's growing at 40, 50, 60% a year to put a toe in the water.
So I think that's maybe what the average Joe who does have a little bit of a longer term horizon, maybe it's a few years because they want to buy a home, they want to save up for a home, or maybe it's even longer than that. But what would you recommend to that investor? I mean, would they be safe to put their money in now, or do you anticipate, based on this action, Keith, that it's not just going to kind of be a sideways movement, but that we might see a steeper pullback?
Well, a pullback is always possible. I mean, you know, that's just the way the markets work. But people forget that that's actually normal. You have to have buying and selling to move forward. So if there's any young investor coming to me, say, what do? I say, you know, you pick the companies that are going to be around in 5, 10, 15, 20 years. And that's a very short list. That is companies like Apple. That is companies like Microsoft, for example. Tesla is a good bet as well. The recent price is almost irrelevant in the scheme of things if you have a vision, a plan, intention, and the ability to control risk management. Investing a little at a time over a long period of time is the path to profits, and history is very, very clear on that.
Okay, so it sounds like, Keith, you don't feel uncomfortable putting money to work if you were an average investor in the NASDAQ right now, right? Despite a lot of concerns that higher inflation might cause the NASDAQ to see a steeper pullback than what we've seen during this past year.
No, I'm not concerned at all. As a matter of fact, I'm not concerned for my own money. You know, I continue to look at this because, you know, would you go to a 50% more sale at your favorite store? No. But would you go to a 50% less sale at your favorite store? Absolutely. And tomorrow's tech is not even remotely valued into this marketplace right now, which means that companies like Apple or Microsoft or Palantir, for example, you know, even though these companies are expensive by historical standards, they're probably dirt cheap by what they're going to achieve tomorrow.
That's really interesting. When it comes to this economy, though, is inflation worrying you at all, Keith? And when we talk about certainly some of these, you know, bigger hedge funds, bigger institutions out there, I think the concern, and we kind of saw it in the minutes this week from the Fed as well, is that the Fed might start having real conversations about scaling back its asset purchase program sooner rather than later, as we see a variety of things contributing to higher prices.
I think that's a sharp question. And yes, I am very concerned about that because I think the Fed lost the plot a long time ago. And this idea that you can hand out free money to everybody and not have repercussions is absolute fantasy land. The only question is when we're going to get them. As an individual investor, you know we could get around that if we invest properly. But as a government, as a nation, it is problematic.
I want to get your take on cryptocurrencies because you're clearly bullish on technology of the future, which I think many people are. Maybe the timing, they have questions on it, given the state of the market right now. When is the best time to buy? But of course, if you have a long-term time horizon, it doesn't really matter. I do want to get your take on cryptocurrency because I'm wondering if you see that as a technology of the future and something that you would be interested in.
Well, I'm buying a little here and there myself personally because I think it's going to be a store of value, not because I believe it's going to be a currency. I think the interesting play here is that the United States government has to get into the digital game, whether it likes it or not. China is already digitizing the yuan. They have already surpassed us as a trading dominant partner in the world, and that means potentially the U.S. dollar is at risk from China weaponizing Bitcoin or cryptocurrencies, and not a lot of people think about that.
I'm also curious, the biggest tech names out there, they always do get a lot of love. There's no doubt about that. Palantir is an important company as well, a defense company. I think about more of the recent storylines here, Keith, these cybersecurity companies. Obviously, I think seeing some renewed focus these past 2 weeks in the wake of that Colonial Pipeline hack. Is that a sector that you might see some opportunity in right now?
I think perhaps that is one of the single biggest opportunities of our lifetime because our entire world is shifting to digital technology in one form or another. Everything from my refrigerator to my car is beginning to talk to each other. So it's natural that we've got to protect that. And the Colonial Pipeline thing was an absolutely glaring red alarm wake-up call for this nation. It's also a glaring engraved invitation for investors because trillions of dollars are going to have to get spent to protect this country, to protect our privacy, to protect our currency, to protect our transaction. And that's very, very significant.
And Ford was our stock of the week. That stock actually doing very well, despite what was a rocky week for the major indexes across the board. The Dow ending on, a relative high note today. But we did see a lot of selling pressure earlier in the week. Ford unveiling the F-150 electric vehicle. Its F-150 is super popular. Right now, its most popular vehicle, I do believe, among its customers. When we talk about the technologies of the future, I think that certainly viewers, they can't overlook some of these electric vehicle makers. What do you make of the new Ford unveiling this week? And is that a space and perhaps a stock, an individual stock that you like?
Well, I tell you what, I don't own it at the moment, but Ford has definitely got my attention. I mean, how cool is that we can finally have something that's homegrown, that looks great, functions great, has great promise, and on top of that is a terrific truck. There's no question we're going to EVs, and I thought it was really cool, and my hat's off to Ford for being able to pull this off. I didn't think they were going to 24 months ago. Mm-hmm.
Look, as we get this reopen underway more, I'm just thinking of, asset classes across the board, some riskier ones, the state of the U.S. dollar. Obviously, long term, I do understand that you're very bullish on growth sectors going ahead. What about international stocks? What about emerging markets? Are those places that investors should be looking at as well, or are those places that you would avoid?
I would encourage them to look at it because we get so caught up in the news cycle here at home, we forget that the recovery, the global reopening is also happening thousands of miles from our shores. So it's companies that are going to capitalize on that in places like Africa, for example, or the Far East, or even South America that are going to be real winners 5, 10, 20 years out. Africa, for example, reminds me an awful lot of where China was 20 years ago. So I'm looking at, who's the Amazon of Africa? Who is the Apple of Africa? Or is it Amazon and Apple moving into that space? But either way, I don't think you can ignore it, and I think you'd be foolish to ignore it, frankly.
All right, Keith Fitz-Gerald, principal at Fitz-Gerald Group. Keith, thank you so much. All right, well, coming up, the White House.